interest rates impact stock prices. One of the things that people talk about, sometimes you may hear in the news, was this idea of a Greenspan put. And here's Investopedia. So the idea was that if the stock market declined over 20%, which is like a bear market, that the Fed would lower the Fed funds rate. And this flows through, and so it changes the way that people value companies because banks can lend lower, et cetera. It flows through the economy. Anyway, the point of this is that what happens is you have some interest rate for a stock, and then it is decreased by the Fed or by the market in general. And what happens to the price of the stock? So let's just do a hypothetical example. So let's say we have stock A, and in time 0, 1, 2, 3, and for the moment, let's pretend there's no dividend. In fact, in this example, I'm going to pretend there's no dividend. So it has some cash flow, and let's say in year 1, it's $100. One easy thing to do would be to have, let's say R equals 8%, and let's call it a perpetuity. So this $100 is going to go on forever and ever and ever and ever and ever and ever and ever, all the way out to here. Let's just, but pretend the timeline goes to infinity. So if it's a perpetuity, what's the value of the stock? Well, it's just C over R. So there's C and there's R. And here's the value of stock A. And to be honest, most stocks are somewhat similar to this. So you can make assumptions about how it grows. You can add an R. You can do whatever you want. But for our purposes, let's just say it's $12.50 or it's $100 forever. Okay, so keeping it at $100 forever, it's $12.50 at 8%. So let's just make a little chart here. The price of the stock is $12.50. Okay, let's say that the Fed cuts rates. Now at 7%, it's worth $14.29. At 6%, it's worth $16.67. Let's just do a couple more. There's a way that you can do this in Excel. 0.05. There's a way you can do this in Excel using the scenario analysis. I don't really want to do that because I would have to do a lot of work, but it's there if you ever want to use it. 2500, 0.03 is 33, and then 0.02 is going to be 5,000. And I've done this by hand, but like you can, it's not that hard if you do 100 divided by 8. I just kind of wanted you to watch me go through these. Notice you get, I gotta lock the 100. Notice you get the same thing. It's the same answer, and it can be generated dynamically, but I just wanted to show you that it would work. So anyway, now that we have the stock price, here's the growth rate between them. So this is that divided by that minus 1. Let's get back to percents. So notice that the increase in the stock is much, much higher. So for instance, when we go from 7 to 8% or 8% to 7%, the stock price goes up 14%. By the time we get to 2% or 3 from 3 to 2%, we get a 50% increase in the stock. So this stock goes up by 50% just by a 1% decrease in interest rates. Now we are in an environment of very low interest rates, and the Fed has been committed to raising those interest rates. So the question is, should the stock price go down because you're reversing, right? And I'm not sure of the answer for that, right? Like there's an argument to be made that you have the same stream of cash flows, and therefore when you value those cash flows that you should step back down in price, which is the big worry that by raising rates, the Fed is going to put us into a recession because asset values in general. So this is just a stock, but think about like businesses. So if you value a business is a stream of cash flows just like a stock is. So if you own your own business, the value of your business would go down in theory as rates go down because you can't sell it for as much. There are lots of other things that could impact this. So if you're in a recession, maybe prices change or things change on the cash flow end. Maybe people are willing to pay more for that stream of cash flows, which implies like the discount rate is not the same rate that the feds have. I don't know. There could be a lot of things that impact this. So it's not clear to me that for every percent increase in stock prices that, or increase in interest rates, that stock prices are going to go down necessarily. But that is one of the worries, is that as the Fed raises rates, the discount rate for stocks and in general any asset changes and goes up as well. And therefore the value of that asset goes down, and that pushes us into recession, which is by most people's consideration bad. Again, I don't know if this is like perfectly true, but this is the way the math works, and in a vacuum, you should see the price decrease.